Welcome, everybody. This is the sixth installment of the syndication e-course Saturday school that we do every third Saturday of the month. If you guys have access to this, it's the number 6 section, syndication documents. If you don't have access to it, I believe you have to book that onboarding call with myself. To do that, you got to go to thewealthelevator.com, sign up there. A lot of you guys have been signing your friends up so you guys can both go through the e-course together. This thing takes most guys, let's say 8 to 10 hours to go through. It's a little dry to going it through yourself, which is why I'm recording these videos so you can hear it multiple ways. I always add a little bit different insight, and those of you guys who do jump on this live can ask any follow-up questions that you like. Syndications and private placements, it's not super complicated or complex. It's just, at least speaking for myself, I've never heard of this before 2012 myself. And it just was like nobody talks about this type of stuff. If anything, it's just invest in rental properties. But I think most of our investors, you guys make multiple six figures at your salary. You're intelligent people and you'll pick up on this pretty quickly, I think, by going through this e-course. But the first thing here, so we already went through the deals, the numbers, vetting people, and then also the LP checklist. Today we're going to be going through some of the syndication documents. Some people, the way they teach it, they're like, the documents are so important. I've always been, you can have great documents put together by great lawyers, but if you're working with crooks or unsophisticated newer sponsors under $1 billion of assets under ownership, the docs don't mean anything. And I've been there, done that, right? Actually, maybe that the documents did save me, because in some cases I was able to kick out the general partner myself and run the deal. These syndication documents are 50, 100 plus pages, pretty briefy documents. Most times it's going to be electronically signed. The reason why we don't want to have them physically signed is that's when there's no like kind of barcodes or electronic signature codes assigned to it. And to me, as the syndicator, to me, that's when documents can be forged or somebody signs, yeah, I'm in this deal for this much. Where's your wire? And we required you to go through our electronic signing process. Plus, a lot of these syndicated deals these days are using these nifty third-party signing portals, which administer the documents and then also administer the wiring instructions, which it's pretty important to not get the wire instructions through a text message or an email. I guess email would probably be the worst, because it's pretty common knowledge that hackers will swap out wiring instructions. Sometimes people would get on the phone and verify it with a live person. But what we found in best practice out there is if you administer the wiring instructions through a secure portal where the hackers can't touch the portal, and you pull it yourself as the investor, that is a best practice to get around that. So the syndication documents is made up of a couple of things. You've got the PPM is what we call it for short, which is a private placement memorandum. And it essentially discloses everything to an investor to make the best decision that they can. In most cases, the PPM is just a document that sets the terms of the deal. Has nothing to do with the deal in most cases. That's usually going to be in your marketing documents or any type of webinar that was put together. That's going to be talking about the deal specifically. The PPM is just going to name the deal and then also provide a lot of other caveats. And what I tell people is that PPM, what it's supposed to do is set the terms of the agreement so that essentially the syndicator operator has fiduciary responsibility to the investors, the LPs. I take that with kind of great responsibility, and of course, then overlays people's value systems on top of that. One of my big ones is honor. Don't do stupid stuff that's even on the fringe there, right? Put the investor first in mind. People need to put it on paper, right? And that's what the PPM does. It signs the syndicator up for fiduciary responsibility. Now, on the other side of that, it signs the passive investor up to say, hey, man, this is an investment. In every investment, there's risks. And here are 20 to 50 things that could go wrong. Zombie apocalypses, market correction, and the list goes on. Some investors will say, hey, this is just giving the operators a free pass. Yes, but also your operator is acting in fiduciary. This is a checks and balances. And part of this is we live in a very litigious society. I've never seen this happen, but I've heard some LPs, if the deal gets sold and everybody makes 22% a year and more than doubles their money. And they say the marketing document said I was going to get 24%. Pay me my extra and I'm going to sue you. To me, and again, going back to my honor code, that's ridiculous, right? I think everybody would think that. But that's where the PPMs protects the operators. And if you can, using that one example, you can see where I'm coming from. Where are these disclosures, why they're there. And I got to be honest, there is a whole bunch of stuff in that PPM. It's a lot of border point. You can usually spot it out because it's written all in capital letters. I don't know what it all means in there. I've been through a lot of circumstances, again, with bad partners and had to actually use some of those blurbs in there. And you learn by experience some of this stuff. The one thing I would do when I go through a PPM as a passive investor is use the Control F button and go look at the fee structure. Just type in FE, fee, and just make sure it matched up with what your understanding was. Most times, acquisition fee, asset management fee, distribution fee are discussed and pretty openly in the marketing deck and should match up with what your understanding is on the PPM because at the end of the day, it's that PPM that reigns supreme. Some investors, they think that the webinar or the pitch deck, if there's any kind of misalignment in it, they're going to use the one that's better to their advantage. In reality, it's that PPM document. And when I've had disputes, for me, the lawyers always tell me, it's like, what does that PPM say? What does the operating agreement say? At the end of the day, it reigns supreme. And if you're a passive investor saying that the marketing website or the pitch deck said this, you're fighting on a loose leg there. It's what the PPM says. So make sure this is the time to just make sure you understand things. And that also goes for like the deal splits too. So whether it's a complicated waterfall after investors get 1x their money, then it goes down to a 70-30. And then when it goes to 1.5x, it goes down to a 50-50 split. Is that split cumulative? The PPM is supposed to spell it out. And oftentimes it's confusing. Luckily, we live in a day and age of ChatGPT. So just copy that sucker and put it into ChatGPT and tell me like it was I'm a 12-year-old. Of course, use your own common sense when you do that, but it's actually a fine way of breaking things down, maybe even line by line if you don't understand something. But those would be the big places I check personally, the fee structure and then the split structure. And then the next one would be like, all right, what if there's some type of dispute? Most cases in these types of arrangements, the managing members, the general partners, have pretty much supreme ability to do what they want with the deal. Of course, governed by fiduciary, right? The passive investors, to be honest, most times you don't want the passive investors making decisions. A lot of times, passive investors are not as sophisticated in the market, in the know as the general partners, and they can be oftentimes governed by fear and emotion. I think that's probably the way I would want it. Even being an operating general partner, if it's not my deal, I'm not in it, I want the control to be with them. Of course, the trump card over that is if there's any type of wrongdoing, fraud, anything like that, that should trigger the ability for the passive investors to do some type of like mutiny on the deal. And that's actually one that I actually did have to enact personally and successfully overthrew the government and got the general partner out. And then I had to run the deal, and that was not fun. The other thing about that is when passive investors don't have the management authority, that also creates that air gap in terms of liability there. I've seen it where the passive investors, if the deal doesn't go well, of course, there's emotion involved, and the passive investors somewhat get involved. But a big red flag there, I would say, is now you've crossed that line between a passive investor and a managing member, and you've opened yourself up to legal liability because now you are a managing member too, in a way. This is a kind of an old video back from 2020, but my lawyer came on, who actually still does a lot of my PPMs today. So from his eyes, what are some things to look out for? So I think that's a good video for you guys to take a look at later. The other thing that might be of interest, maybe for the engineers out there who like to get into the nitty-gritty details for some strange reason, other than what we talked about before. But like some people, they like to understand the org structure in terms of how the LLC, usually you have the building 123 Main Street apartment is owned by an LLC. And that's how, and investors might be in another LLC that own 80% of that. And then the general partners are in another LLC that owns 20% of that. You might even have an outside tick tenant in common, or another party that owns maybe 10% of that said LLC, or owns it in parallel with the general partner LLC. All this, it creates things a little bit complicated. And I would probably say in most cases for passive investors, it doesn't really matter. But the PPM should outline this in a way. Sometimes they even have diagrams, but most cases, the diagrams are put more in the marketing materials for investors to look at it there. In my opinion, it doesn't really matter, right? Like at the end of the day, and this is what maybe I just because I run my life by like this thing, honor, and like at the end of the day, of frank mode, the passive investor is coming in. They're presented a prospectus that a deal is going to hit a certain projected return. Let's call it 80% return in 5 years, whatever. And investors need to come in understanding, yeah, things could happen. Things happen. Things could go really well too, right? The market could accelerate to the good side. It could also go to the bad things. Like things are going to happen. That number that's put out there in the beginning is just a wild guess. Of course, it needs to be based in some reality. And we talked about this in number 4, the number section, right? Like you don't want your sponsors and operators to be using zany reversion cap rates and audacious occupancy numbers and thinking that the rents are going to skyrocket to skew their numbers one way or the other. But assuming you've done your due diligence there and your operator isn't using crazy assumptions, this is where the numbers should land, right? And the passive investor needs to understand that things are going to go one way or the other. And the passive investor should also be investing in multiple deals. And ultimately, it's, hey, if you weren't happy, you don't have to come back and invest the next time. That said, you're stuck with each other for the next 3 to 6 years, which in fact, it's like it lasts longer than most marriages. You're stuck in it. It's a liquidative investment. The general partner is stuck with you and the passive investor is stuck with the general partner. The way that the deal is structured and split, where there's carried interest, it creates a nice situation where the general partner should be motivated to do their job. And the passive investors are bringing in their money passively and should be making a nice little alpha on what they could be doing with the money elsewhere. So this whole structure, again, is a very common structure out there in the deal making world. I know for a lot of new investors, it seems like playing a game in Vegas where you don't understand the rules and the odds and you're unfamiliar with it. Just know that these 70-30 splits and these 50-50 waterfalls are very common in this type of real estate world. No, I'm personally moving a little bit and I'm not really moving, but I'm just interested in different worlds such as angel investing and venture capital. There you have a little bit different split structures because those are a lot more speculative in nature, but it's still within the same planet, right? You still have these split structures, these waterfalls. But getting back to what I was talking about, the PPM is set up to just set the terms of the engagement. The general partners are incentivized to do a good job, and passive investors, they'll be communicated of things going well or bad, and they can base that decision on the next deal that they do to come back and invest with this sponsor again. And any good sponsorship company should be taking their acquisition fees, all these fees that they're making, and building up their team and staff. They should not be still working their IT job on the side or engineering job on the side as they pocket all these fees and don't grow as a company. They need to be growing assets under ownership, growing the muscle so they can do a better job the next time and essentially growing the great American company, right? Growth. So that's my take on putting this all together. And I think at the end of the day, it's the basis on honor and doing what's right. And everybody's swimming in the same direction, right? Everybody has their roles. And for that, the passive investor is to bring in your money. And that's it. Just so you guys understand some of these terms, these are different, all kinds of places, but the executive summary is the quick snapshot of the deal. Most investors investing in these types of deals don't read anything other than the executive summary, right? You're busy, but if you're a new investor out there, you may read it. And if you're an engineer, you guys read everything. I tease you guys because I'm an engineer too, but I'm a little bit different, obviously. This stuff will have photos, It is funny. Deals that are more geared towards retail investors like us, they have a lot more photos or they point out things like, oh, guess what? This employer is moving over at next block. Things like that, where institutional investors, the pros, their decks are a little bit different, where it's more numbers driven. What's the CoStar report? What's the inventory coming online? What's the absorption rate currently and the occupancy rate? It's funny, right? Because I in a little bit in the middle of both of these two worlds. It's fun. Like some retail investors will be like, I don't really see any new employer coming by. The sophisticated investor will be like, who cares, dude? Look at the numbers. Look at your occupancy. Look at your absorption rates. Don't base this off some emotional kind of thing that you can point to, right? And hopefully I'm describing this the right way. So that's the executive summary. You got the limited partner agreement, but sometimes this will be called the company agreement, the CA. And then you've got the subscription agreement. And the subscription agreement is pretty small. It's usually a section on, hey, make sure you're not some random person who's not qualified to invest in this type of stuff. If it's a 506B offering where they do allow a limited number of non-accredited investors, which I don't know why people do these things because you probably don't want non-accredited investors investing in your deal unless you're desperate for cash because non-accredited investors are a handful to deal with. It's like my 2-year-old right now. Every time we drive anywhere, we get going. She's, I want out. I want out. Dude, we're gonna get there. Then we can get you out. That's how non-accredited investors are, and some accredited investors are. So you put 100 grand in here. If you needed it in 3 months, you shouldn't have invested in the first place. Yeah, sure, I'd like to let you out, but the car's moving. We're in the airplane. We put our money in this liquid investment. I'd like to help you out, but we can't. It's some people just don't have the appetite for this type of stuff. And this is why this is the big hit club. And this is, I think, why I've moved more to accredited only type of deals. In the beginning days, we would do 506B offerings, but today strictly 506C, which is accredited only. But that subscription agreement, I wouldn't say it's not like you're applying for a job, right? Relax. You just got to put your information in there and it gets stuck in the file because it's something that the SEC requires of us to do for all the investors. There's also a Corporate Transparency Act that kind of came out the last couple of years. I do believe that that Corporate Transparency Act has created a situation where passive investors need to also maybe take pictures of their passports or their IDs. It's kind of part of the Know Your Investor requirements put out by the SEC and the federal government, where they want to make sure that you investors aren't like drug lords or criminals from foreign criminals and just laundering your money in these types of things. So there's some checks where we have to the best of our ability, make sure you're not like a foreign criminal, basically. And also, obviously, the government wants to know everybody's stuff, right? They want to know everybody's LLC who owns it so that they can. I'm not going to get into the Corporate Transparency Act. It's a trigger for a lot of people, anti-privacy. I'm not a huge fan of it myself, but it is what it is. But that's what the investor suitability standards are. In most cases, I'd say the best practice, just get a quick letter from your CPA or lawyer or buddy who has one of those designations to just sign for you. Our team has a couple of form letters. We've got a real short and sweet one, and we've got a little bit more detailed one. Either one's fine. A lot of times, if you make it easy for your professional, like type up the form letter and give it to them and have them just e-sign it or sign it. I don't know who even does job references today, but you better not have your boss write it for you. You got to be joking me. You want to write that thing out, and if they want to wordsmith it after, that's fine on them, but make it easy on them. Like I said, the PPM has the risk factors disclosed in there. We all joke and laugh because it's like, if you're one of these people that gets freaked out about all these little things, go ahead and read all the bold letters, the capitalized letters of all these risk factors. We keep adding to them like pandemics. Who would have known? But there's all these risk factors out there. And a lot of that is, there'll even be like a taxes one. Like we try to do the taxes as best for our past investors and our partnership. But if the government changes some kind of tax thing in the tax code that we have no control over, like I think a lot of you guys would side on me on this. It is what it is, but it needs to get put in on that risk factor section. It needs to be disclosed. And the saying that I use all the time is, we wouldn't be doing this if it weren't for lawyers. I think most of us except the lawyers out there sigh in frustration over that. Here's one, the maximum and minimum amount. I don't think this is super important, but for some reason new investors always key in on this. This is just for me as the syndicator. Say I put the maximum amount as $5 million and we want to do something changes and we need to raise $5.5 million. I can't do it. Now I got to spend another 20 grand to the lawyer to make me a new PPM. That'd be ridiculous, of course, right? So that's why a lot of times the maximum and minimum ranges are expanded greatly to just avoid that type of brain damage there. In most cases, if you're in a single asset LLC deal, if you don't get enough money to buy the asset, it's a failed launch. And most times the investors are returned their cash, or at least this is how we've done it. But I suppose, yeah, check your PPM. What does it say in case of a failed launch? And most times this kind of goes from an honor standpoint where if we didn't raise enough money to, which has actually never happened 60 something plus times, but if it did happen, our assumption in those previous deals was that we just give investors capital back and we as general partners eat the cash. Actually, it did happen. Actually, it did happen a couple of times, but we, the general partner, just ate the losses. And I think that kind of speaks to like the honor code, right? It's like it was our job to get this thing going, so we ate the expenses at that point. But the minimum and maximum dollar amount that I would say maybe I'm missing something here, but it's really not a huge issue. So here we'll talk about conflicts of interest. Most cases, the PPM will protect the general partnership of conflicts of interest because there's always going to be conflicts of interest in everything a general partner does, unless they're only involved in one deal. And if they're involved in only one deal, you probably don't want to work with them, right? That's a newbie. That's somebody who doesn't really have a track record. Of course, now we're talking about different levels of conflicts of interest, right? Is the general partner going to sell an asset to themselves in a LLC and dump the investors and get some new investors and themselves in that new LLC? That's messed up, right? That's a huge conflict of interest. That's, again, goes back to that honor code. I see it out there. I see these things. And I think that's what it goes back to, working with people you trust and have the investors best in mind. And yeah, it's a lot of trust with investors. And part of that, the checks and balances of that is as a general partner, you got to make your customers happy and so that they come back because you want to grow a sustainable company where you have referrals and you have repeat customers. If it was just like new investors all the time, that would be a lot of cost to generate that new list of investors and onboarding them and handling new investors all of the time, which I get. There's an education process, but continually going through that is very costly and not a good way of growing a sustainable company. But yeah, I'm in a lot of deals and there's always things that pop up where things impact each other. Like we have a development that's almost completed now in Huntsville and we own the adjacent land. They're two separate syndications. You would think if we built a multifamily right next to where we're at, that would cannibalize the residents, creating more supply in that area. But then obviously that would increase the returns for the new syndication. Maybe people think that I'm an analytical person. I guess I am, but I normally know when that there's right in the sea of gray. And in that situation, I guess what we're doing now is we're just waiting and waiting for the time. We're trying to see what the price is on that barren land next to our almost completed apartment complex to see what else is out there. Ideally, we'd like to sell it to somebody who's not going to build residential multifamily there. Maybe sell it to somebody doing like single family homes or sell it to a person who wants to put a gas station or a strip mall there, right? So it doesn't hurt our others. The way I see it, like make those common sense decisions. And passive investors, you also have to understand that I'm in both deals. I get carried interest on both deals. So it's not like it's a huge conflict of interest. I'm in both, right? So I want what's best for everybody and to try and find the best solution for everybody in that particular case. And there's cases upon cases. Things will overlap. It's inevitable. which is why the PPM puts in there that, hey, man, guys, there's going to be conflicts of interest here or there, right? It's just putting it out there. What was the saying I heard recently? I just thought it was funny, right? People are going to be upset at certain things. There's going to be overlaps here, there. I take a more utilitarian approach to things, making the most amount of people happy. And part of that is sometimes you're just not going to make people happy. For a lot of you guys are middle management or upper management, you have people working for you. You're not going to make everybody happy, and you're going to make the best decision for your team and your staff. And there's just going to be some unhappy people out there. Just like our apartments, right? We go in there, we kick out these deadbeats. We don't want these guys. But we know that 80-90% of the current residents there, they want those deadbeats out too, right? It's a utilitarian approach. So that's our thinking. Oh yeah, I was getting to the quote. I think the quote was Mark Cuban. He said, if I was in the business of making everybody happy, I'd be selling ice cream. But not many of us are in the business of selling ice cream. Anyway, I'll move on here. So yeah, so here's the role of the LP. You bring your money in, and if there's more needs of money, that's the role of the capital partner. So this is what we said. You don't really have any manager abilities unless what this is commonly known as if there's any type of like good cause, like gross negligence by the operator, or if they're embroiled in any type of wrongdoing elsewhere that can usually trigger this. And this is again where you have to get like a lawyer to come in, and then he's going to say, where is the company agreement and the PPM? Let me see what that says. That is the Bible. Because sometimes it's not in there, or you may need a super majority pro rata of the equity. So if the bad party general partner owns 90% of the general partnership and the supermajority can't be reached with an LP vote, then it becomes very difficult. And in the case that I referenced a couple of times, I was not the majority GP. I think I was like maybe a third or something like that. But there was another partner that was like maybe 5-10%. So together we could not overthrow the government, his 55% or whatever it was. So that would have been easy, right? If we were 51%. Good. GP, we huddle, we vote, and we're done. He's out. Easy. But what it required us to do is like we needed to enact the vote of the entire partnership, including the LPs, to overthrow him on a supermajority. Now, sometimes it's just majority, right? And this is where the lawyer is going to get into it. What is the PPM company agreement say? I don't want to disparage investors here, but I want it to be like a kind of filter the way you look at your investment amounts. If you're an LP, it's of course if there's like fraud or anything like that, right? That's a big one. That I always think that should be you always take action on those. But if it's something like it could go either way in terms of how it could be settled or arbitrated, to mount any type of legal dispute costs a lot of money and time. And then this is why we put together the income fund where I'm the fund manager. If anything should go wrong with any of our partnerships, my allegiance is to the passive investor base. So I'm that representative to spend the money and fight and use my relationships to get the best outcome from our investors, which is why the income fund is a huge leg up as opposed to being a little passive investor. Most times these legal disputes, it's going to cost like at least 50, maybe even 100 grand if you don't have a huge legal stance. So most cases, a smart lawyer is going to tell you, hey man, are you really going to go spend 50 grand? I'd be more than happy to work it for you and just milk the clock to go collect a fraction of what your initial investment was. And that's where it's like throwing good money and bad money. And this is, as we all know, why most cases out there even outside of this world are settled. And this comes up a discussion of you don't want to invest more money than you feel comfortable obviously losing for the deal to go south, or if there's any legal issues to happen. Now, most people make a lot of money and their time is better spent on making more money, especially if they're a business owner, especially if you make over 300, 400 grand a year. You're not going to go chase somebody after 25, 50 grand, which would be like maybe the disputable amount that you maybe could get, right? So it's just, I say that not to disparage people from investing, but just to think about in terms of, am I really going to make a big stink about this and spend my own legal fees out of my own pocket to go after what you may think is the right thing. This is probably the stance that I took my first instance where I think I lost like 40 grand. That said, I was a non-accredited investor back then, and 40 grand meant the world to me. But in that case, I did seek legal counsel. I must have spent like a few grand just to talk with the guy for a couple of hours and for him to do some background checking on this. But I pulled back and I just ate it. It just wasn't worth it. Now, maybe if my net worth was 500,000 and it was like 400 grand, maybe I would have pursued it, but it's just silly from that respect. So I guess the summary here is no different than any other time. Don't invest more than you can't afford to lose. And this is the big boys club. And if you want to use this to get to financial freedom, how the big boys do it, these are the type of risks that you need to take on. Now, I don't want people get people scared by that, right? The reason I'm saying this is you need to diversify. You can't just be investing 10, 20% of your net worth into alternative investments. I very quickly went up to 80%, maybe even more of that than when I got started with this, when my net worth was about $1 million. And why did I do that? Not only did I believe in this stuff, but I needed diversification. And quite frankly, being in one, two, three deals is not diversification. Things will happen. Sometimes on the dispute side, and sometimes just quite frankly, the market. The market here in 2022, 2023 created a lot of, I was going to say headaches, but more than headaches, right? The market came down 30% from 2021 to 2023 because it was a black swan event. Interest rates went up, quickest in history, 40-year high. Quickest in history, 40-year high. So PPM signing guide, again, this is not legal advice. Most people, after your first one or two, most people don't really read the thing. Again, that's what I do these days. I just go to the hot spots, control F. I know which ones to find it. But I suppose most people read these things and freak themselves out with all the risk disclosures. If you're really a newbie and you want to hire an attorney, most of the attorneys don't want to touch this stuff because it's like, it's just not worth their time. If it's not their PPM, they don't know where all the landmines are hidden. And it's going to take them 2, 3 hours to really give you a good review of it. But then again, like I said earlier, the PPM really has nothing to do about the deal. The deal is in the number section of the syndication e-course. The PPM is just like the skeleton. And if you have dishonest operators or incompetent operators, the PPM is not going to help you out at all. I think Dugan, the guy in the video up above, I think they do have a retail investor. Hey, we'll check out your PPM for you. It might cost like $1,000 or something like that. You guys can connect with him or just shoot us an email. We can connect you. I don't know if they do that anymore because it's a real silly way of them making money. That's a lot of effort and liability on their side, right? Because the investor that's going to want a lawyer to review the PPM is exactly that investor who like makes a big stink out of nothing and wants to litigate and potentially litigate that attorney who supposedly checked their PPM. So you see what I'm saying here, right? Okay, so common things that I see questions popping up for investors going through this water slide on the first time. People get tripped up on, hey, do I put it as individual, joint, community property, all of this stuff? To me, this joint rights of survival stuff, my understanding, again, not a lawyer, again, I'm not giving any legal advice, but my understanding, all that stuff is really old school ways of signing for documents where today the modern way is just use an LLC or if you're really that high net worth, spend the 30, 40 grand and get the irrevocable trust. That said, most investors that we see just sign it individually because it's simple. And this is not like real property where there's liability. You're a passive investor. So there's really little to no liability here. That's the beauty of a passive investor. From the slip, trips, and falls and that kind of liability and the recourse from the bank, you're not signing on the debt. So you're just a passive investor. So that's why we see most investors just signing it on it individually. And then you sign it as an individual, but then that joint of ship or whatever, like that was what I was referring to as, nobody really cares about that type of stuff. Now, some of the old school attorneys will say, oh, that's super important. But if you have a trust set up, that trumps or covers that angle. Kind of doesn't matter, but hey, I'm not an attorney. If you guys need a referral to attorney, reach out to the team. We can connect you with one and you guys can engage on that. Some people like to do LLCs because for most people over a couple $1 million, what they like to do is have a setup where they own a holding company and they have that holding company owns all their investments. And if they own rental properties, you probably need to separate out your dirty high liability rental properties on the side. Don't commingle your clean passive investments, your LP holdings with the dirty rentals. And certainly don't commingle it with your business. He had a guy, he had a janitorial company. That's a dirty business. But we're talking like when you especially have employees or somebody could get hurt more in terms of dirty. But he was thinking about putting this LP holding under his company, the janitorial business. I said, no, don't do that, buddy. Like separate, even if you sign for this individual, just get that away from dirty rental properties and the business, because that's the high liability stuff. You don't want it to be commingled. The other nice thing about that holding company structure is it doesn't really provide any asset protection because you don't really need it. But from like a container's perspective, like if you died or eventually if you want to give it to your kids, it's just so much cleaner saying Billy gets 49% and Sally gets 51% of this holding company that owns these LP holdings and these two rental properties and our business than to go into each one and say Sally owns 51% of this and Billy owns 35% of this. I guess if you want to do it like that, you can, but most cases people get rid of the individual rental properties, especially when they know they're on their last decade of life. They like to get rid of that type of headaches and then move more into the passive side. Another way people sign for this stuff is through trust, but unless you have a expensive irrevocable trusts do nothing for asset protection. They do nothing. Trusts are just simply a way of avoiding probate and the money goes straight to you. Whether you sign for this stuff in a trust or your personal name or your LLC, I think that's why people work with us because we know who you guys are. I would say the only point of contention is if your spouse comes and claims the money at the end of the day, although we just send it to the same bank account on file when we exit. But if your spouse came around, I'm always going to be scratching my head a little bit. Did you guys get a divorce? We don't see Robert anymore. Where did Robert go? You guys get a divorce? Let me see some marriage delusion documents or the trust, right? The trust tells people what are the directions of the assets. But this is where, again, not giving legal advice, but just trying to save people a lot of time here. What a lot of people in our group will do is you have your trust, and in your trust, you have in the last page, the appendix, which is actually one of the most important pages in your trust, is a list of all your holdings and assets. You should be updating this pretty routinely, maybe every month or quarter or as things change. Of course, nobody does that, right? You got better things to do than updating your assets on your trust. But it would be advisable if you are a smart guy or smart gal, if your spouse died, you go over to that last page of your trust and you start to fill in exactly what that trust owns. Like doing the homework the morning of score, right as they collect the homework in a way. Now, you didn't hear that from me, and I'm not giving any legal advice for the fifth time, but that is a way that I think that a lot of people are doing this so that they don't have to sign on behalf of the trust and just individually, but the trust names these specific holdings. Because if you're any what of a diversified investor, you're going to have dozens of these types of holdings out there. And this is again why you need to get around other high net worth accredited investors doing this stuff. And if you guys are investing more than $250,000 into these types of holdings and more than a couple handfuls of these holdings, and certainly your net worth is over $2 million, you need to have at least 4 or 5 other accredited investors over $2 million, $3 million net worth around you. If you don't, that's what the family office Ohana group is. Reach out on that. I think the URL is thewealthelevator.com/FOOM, FOOM. This is one example of like best practices or how other people are doing this type of stuff. So you don't have to recreate the wheel. There's a lot of other things that I don't write in the Wealth Elevator book, which is the handbook and tricks and tips and best practices for the new multimillionaire, first generation multimillionaire, which is, I think, most of our community here. The other thing is once you sign your documents and you get it countersigned, which could be a month or two later when the asset actually closes, you want to have a hard copy of that on your computer. Notice I say hard copy. Nobody actually prints this stuff out, kill trees with that. But have that signed document with all the e-signature codes on there on your hard drive. Most cases, and the way we do it, like everything is in your signing portal for you to access in the future. And that's where you get your K1s and everything. But it's just best practice to get that type of stuff on your own hard drive. Addendum. In most cases, the PPMs are written pretty generically and broadly to account for minute changes. Again, going back to the minimum maximum amount of the raise, right? It's not calling out a specific number. It's just a wide range. Why? So we don't have to do a new PPM and spend 20 grand. That's one of the reasons for it. The other reasons is like things change, right? The interest rate could go up by a quarter point. It shouldn't materially impact returns and projections. But if it did, what we always do is on the sponsor side is we go to our lawyer, we say, hey, this happened. Do we need to put out an official addendum? In most cases, and then we've maybe only done this maybe 3 or 4 times out of 60 something, where our lawyer said, yeah, just send out this 1 page addendum, hey, the interest rate change, or I'm just using that as an example, but hundreds of things could have changed, right? Through the closing process or as times went along. You should never invest in a deal just based off of one little change. But I guess some people look at it that way. So each to their own. But I want to protect myself, the syndicator, in this way that if a investor came back and say, "Well, you didn't tell us this," that we put this addendum out. And in a way, I think this kind of gives the investors the ability to back out if this were to happen. But man, yeah, you lose a lot of face, I think, when you're doing this. Honor goes both ways. So at least with the people you want to work with. But there's some FAQs here, but anybody want to ask a question or? Yeah, so we had a question on risk and risk mitigation. Now, I think what we're talking about today is a lot of the legal documents, and the risk mitigation here is these documents protect investors that you are working with kind of a shady outfit or the counterparty risk. If the operator were to go through fraud or do some shady things through the deal, that there is a mechanism. Of course, check your PPM, what it says, your company agreement, to remove the sponsor as that check and balance. I think, Tyson, what you're talking about is more like market related. So it's not super pertinent to this week's lesson, but I would say right now we're recording this quarter 1 of 2024. If you look at where cap rates were from 2010 to 2021, 22, you saw a nice decrease in cap rates, which means when the prevailing cap rate's lower, that means the prices are getting better and better. Prices are going up. What we saw in 2023 was a correction year, which is very common where the prices dropped at least 20 to 30%. Now, what we're seeing now is the buyers and sellers are still in this like tassel between what's the fair price for these prices. And I do believe that pricing may come down for maybe another quarter, but we're getting there. Anecdotally, I'm a buyer of apartments and other assets, and we didn't buy anything after summer of 2022. And we're doing the developments, but like we weren't buying the multifamily value add stuff. The reason why is because the debt terms weren't there to make the deals pencil, which is why we didn't buy, and which is also why a lot of other people weren't buying. So transactions fell off a cliff to about a fraction or 20% of what they were a couple of years prior to that. Pricing is a product of buyers and sellers. When you don't have any buyers, the prices tumbled, and they did tumble again, at least 20 to 30%. One will look at this and be like, this is a pretty standard textbook correction. And when I talk to a lot of institutional players, this is when they're licking their chops and now they can buy properties at a 7 cap and ride this bounce off the bottom. Now, most retail investors are freaked out. They're not going to want to come back until 2026, 27, which is the exact mistake and what the professional investors will not do, which is why the professional investors are professionals. Now, another thought process on this is like, all right, on the deal level, Lane as a buyer, like when is it that you guys are going to come back in? I think when I look at it, it's when the debt terms that I can get are like right now, the loans are like 50% loan to value. where we used to get 65, maybe even higher than that. Until things can come back up to maybe 60% and higher, I don't think I'm going to be buying that type of stuff. Or we may just switch to different asset classes, is another move that I am looking into. Getting out of multifamily, which I think the good thing for investors is you understand it, but unfortunately, it's a very crowded world. Whereas industrial and retail, commercial is a world of more institutional players. There's less frenzy in those types of asset classes. But yeah, so part of this, there's always a hotter asset class to jump to. I'm sure multifamily will come back at some point. Right now, even with the prices lower, with the debt terms, the deal economics don't really pencil. If you're in a deal that entered prior to this year, or I'll just say at this point in time, your fate could probably be sealed, right? If you bought a property for 60 million and just by pure market deteriorating is worth 45 million, even if it's like super clean and 101% occupied, it's worth 45 million. And if the senior debt on it is 50 million, you're screwed. It has nothing to do with how operations are or if you're cash flowing. You're screwed unless you can come in with $5-10 million to refinance this. I'm sure a lot of you guys have seen the headlines with the tidal wave of renewing debt. That bridge loans, they work well when the market is going up. And when markets are going down and you get caught on your bridge note, you're screwed. And again, this is why you diversify into 5, 10, 20 plus deals and certainly diversify over a long time horizon, 4 to 7 years plus. So like right now, like some of the purchases that we made in 2021, we're able to refinance out of it and get out of these bridge notes into dry land, which is a huge sigh of relief, right? Of course, risk is never totally eliminated, but for all intents and purposes, it's de-risked the investment at this point. But I would probably say around that late 2021 time period is we've witnessed over the last couple of years is a huge black hole up here that sucks in all the assets that got that run up. And then now the prices came down. If you're in the wrong type of debt, then those properties are just sucked into the hole. I hate to be a jerk, but it's just numbers. There's somewhere around like the 2021 vintage deals, like at least speaking anecdotally from our portfolio, that are just there. We're able to get it up into the dry land on the beach. So if that's any indication, if you were to invest prior to mid 2021, just use this one data point, you were able to have that portion of the portfolio safe. And in reality, what's going to happen now is now you have the bounce off the bottom. Sure, there's going to be carnage of the 2022-23 vintage, but because of those properties going away, there's more residents and spoils for the rest of it. And the surviving portfolio will grow even stronger than it once was. Maybe not now, maybe not in the next few years, but it's going to catch that bounce off the bottom. So it's going to be bad for those investors who entered into that black hole of projects in 2022, 2023. But if you're a new investor, man, you should be licking your chops. And if you're a new investor, you may not be aware of all this kind of this situation. But it reminds me of like when I graduated college in 2007, the job market was pretty good. 2008, 2009 happened. There was a lot of layoffs, obviously, and I was just lucky to have a job. 2008, 9, there was a lot of carnage, like how it is now. Good time to be a freshman in college, right? To just be partying up, totally oblivious of what's happening. In a way, when the job market started to come back, I don't know exactly when that was because I had a job and I didn't care. Maybe I'm sure a lot of you guys were in that kind of mode. Maybe that was around 2011 or 2012. And say you graduated in 2013. Wow, you a lucky son of a gun, right? If that was you. But that's the situation we're in. And yeah, a bit of the lesson learned is diversify yourself over 4 to 7 years, dollar cost average over that because you never know what's going to happen. The last market cycle was 12 years of a great bull market. And this last correction gave up 4 years of that. We don't know how long the next market cycle is, but typically they're like 7 to 8 years. So if you sit it out to 2028, you're only going to catch the frothy part of it. And from 2028 to 2032. I'm just spitballing these numbers. ITR Economics is predicting somewhat of a huge recession, maybe depression in the 30s, the 2030s. I know that's a long time from now. And again, I'm not a doom and gloom guy, but if you go and watch some of their videos and what they're predicting in maybe the early 2030s, I know that's a long time from now. It makes a lot of sense that there's going to be a big dump at that point. So the way I see it, just at least for me personally, in a way, it's like the Christmas Carol miracle story, but it's 2024, guys. That may not be 6 to 10 years away. There's time to get your net worth going, diversify over 5 years, and maybe you're able to completely exit out of alternative investments and just go buy a bunch of T-bills and fatten up your infinite banking policy in that time and just live off of a somewhat guarantee 5% and get yourself out of alternative investments because you've grew your net worth past 3 to 4 or $5 million and you're good. Or worst case scenario, you start investing in a few years and you're somewhat diversified for that big pain depression to happen. Let's just call it 232. I guess I'm gonna be like some of these pundits who just randomly says different years and different videos so I can finally get it right. The broken clock is correct twice a day, is what they say. But yeah, the question here is, am I referring to the dollar cost average in this context? So do you mean putting a certain amount every quarter into syndications rather than all at once spreading over time when they will come due analogy, or to putting a certain amount in a mutual fund every month? Yeah, exactly what I'm saying, right? Like, I think the mutual fund dollar cost averaging, you're putting in it every month. But in this big boys club, because the buy-ins are somewhat large, it may take you a quarter or half a year or even a year to save up $100,000. Most of you guys are able to save at least $50,000 a year or $100,000 or even more. So if you're able to save $100,000 a year, the thought process is maybe you try to get into 2 deals a year and you space it out every half a year at 50,000, 50,000. Now, you're obviously going to be exposed if anything would happen in the market until you get like maybe 6 or a dozen deals at least. But hey, it's a start. If you think about it, 2021, 22, 23 was not a good time to get started. And if you went in heavy, which you got to start at some point, right? Like we have some investors that went really heavy 2019, 20, 21. And boy, are they counting their lucky stars today because those deals were able to grow roots and grow, maybe even exit. And they look like geniuses now. But I know what's up. I know what's in the head of those investors and those investors that just happen to jump into the pool before the collapse. It's not one is smarter than the other. It's just dumb luck timing to some extent. And I'll be honest, like when I got involved in real estate, I went really heavy. I went up to 80, 90% of my net worth into rental properties. And then when I transitioned from rental properties to the syndication placements, I did the same thing. And it's not like I'm smart or anything like that. I just got lucky that there wasn't any type of correction between 2015 and 2020. When you're in the beginning of your investing career with this stuff, you're use that analogy of little infant sea turtles making their way from the hatchlings to the ocean. And then all these seagulls are coming at you guys, somewhat representative of newer operators under $1 billion of assets under ownership, right? The guys that troll the websites and put out those Facebook ads for these deals. That those are some of the things you got to look out for. But a lot of it is just timing too. I went in heavy at the right time and I'll call myself lucky. I count my lucky stars because of that. But I was also following that up with all the money that I would save or I would exit out of my other investments would be building to this dollar cost averaging after that. Just like stay on top on I record these and I put them into these sections accordingly so that when you guys go through the e-courses, you guys can have access to 2 different journeys through the same content. So maybe you pick up different things. Next month, a lot of what I've done is following the typical retail investor to private placement investor route. Nowadays, personally, I'm actually looking at different asset classes and even venture capital. And this is just all the progression. Like most of us who start with this own rental properties. So then it's like a logical step to go to apartments, which is a lot of little rental properties. But in reality, why don't you see a lot of people stay in apartments for a long period of time unless they really find a foothold in that asset classes? What I've realized is a lot of high net worth family offices and more sophisticated operators move to other asset classes such as industrial. I know office is beat up right now, although you can find specific opportunities within the distress, diamonds in the rough with office, retail, or data warehouses, for example, within the industrial asset class. But then also gets into the ecosystem or the multiverse of venture capital, tech startups, or private equity getting involved in buying plumbing companies or HVAC companies or buying professional services companies and being the roll up. There's a whole bunch of aging CPAs, a lot of them that don't do a good job because they don't know the difference between ordinary income and passive income, which is why they work those jobs. They're also not the most savvy business people who have succession plans for their companies that they grew. The opportunity to buy up their list of clients and to roll them over into a private equity company is a big, huge opportunity out there. And this kind of gets into syndication is just a method of pooling money together, and you can syndicate anything. Of course, you want to have expertise and having the right operator involved. We're going to get into next month, like other types of things that are syndicated and some, I guess we're going to get into some taxes here, hotels, triple nets. Yeah, we're moving more into the tail end of this, the e-course here. Yeah, to the question earlier about diversification, if you can, this was a really old diagram I had. You can see by the old logo here. This one might have been back in 2019. Today, I have maybe triple, quadruple the amount of holdings I have. And that, my friend, is dollar cost averaging, diversifying yourself. And that's what you want to work towards. I try not to tell people what to do because that's how I get myself into trouble. But if you want some kind of, let's call it a goal to shoot for or like a working model, what I would say would be like, hey, if you save $100,000 every year, you're going into 2 deals a year and you're doing this over 5 years, and 5 times 2 is now you're in 10 deals. I don't, I wouldn't say 10 deals makes me super comfortable in terms of you being diversified, but you're getting on the road there. And what you're going to see happen is once you're in, usually around year 5 is when the deals start to hatch, right? And you double up. So in 5 years, now you're in 20 deals at about $50,000, $100 each. And you see how quickly this has happened. Of course, if you hit a road bump in the road, you go back a year, but hopefully you're in the market and you're gonna get that bounce back off the bottom. So 7 years from now, it's all like it was just never happened. Just like you look back into 2020 when we had the pandemic, the market bottomed out and then it came back. And right now we look back, it's all in hindsight and it's all just a little blip on the radar, as you see. But that's a good working model. And this is where you combo infinite banking along with this. Because as you're feeding an infinite banking policy, the traditional way it's set up is you feed it in 5 to 7 year increments. And in the infinite banking e-course, there is a little diagram every year for 5, 6 years. You're funding the policy and then you're taking the loan and you're putting it into the deal. The next year, you save $100,000, you fund the policy and you put into another deal. And in that time, this is when the deals start to come back. You throw it back into the policy for your 6, 7th year, and you've got essentially a filled pipeline, and you can reallocate the money from there. It's buried in that infinite banking e-course, but I think it goes hand in hand with the concept that I'm talking about here of dollar cost averaging, spacing yourself over 5, 7 years. In this video, that the 2 hour long video that we did. So I think if you scroll over to here, if you go to about minute 49, there is this standard double dip plan. I don't know if that's a good title for it, but it shows you filling up, he's max funding his policy and then he goes out and invests in it. And then he goes and he just continued that for 5, 7 years. And in a way, this kind of regulates you in terms of not just blowing your load in the first year. Yeah, it keeps you in check. Additionally, the nice thing about this, and then when the deals do get paid out, you have this huge container size, which is the whole point of this. As you start to move from the growth years, as you go from $1 to $3 million net worth to four, five, six, and beyond, you have this infinite banking policy ready to collect the money as you throw the money back in the policy, and you're making I would say guaranteed 5% there doing that. The one gripe that people will have when they do this, if people understand the strategy, is I'm taking a loan from my policy and I'm paying myself interest in a way. I get that, right? And because we configure it with the bare minimum of fees and life insurance, I don't really have to worry about my policy collapsing on me like you do when people normal set these types of policies up. I'm just uncomfortable. I'd like to have cash flow coming in now. So for people who are a little bit more conservative, instead of loading this IBC money into a growth type of investment where the growth investments typically you don't have cash flow, right? You got to wait 3 to 5 years for the development to get built to get a nice payout. And those payouts are typically bigger, right? The higher IRR is doing it that way. But investor may be like, I just want to, at least for the first year, right? As I start to prime this pump, I want to just see the cash flow coming back. So at least I can pay the debt service visually, even though I know it doesn't matter. Some investors have done is they go into our tax PAL fund where there's a 24% pref there. So you get that money, I believe in the fourth or fifth month that the monthly payments start to come back at you very quickly. And then you get the tax benefits too, right? You get the passive losses that you don't have to recapture on that. But that's another option to throw 50, 100 grand there to prime that pump of cash flow coming back, as opposed to going into more of a traditional value add deal where the income may be a little bit less than what you would normally like. But in the long term, a more value add or development deal, I think is where you're going to grow your net worth more. And that's what more sophisticated high net worth investors do. They don't care about cash flow. The new investors care about cash flow because they don't got that much money. And I was there at one time myself. All I cared about was creating cash flow to replace my paycheck because I didn't like my job. And goal number one was not to have my day job anymore. But guess what? I hit that goal and I started to hang out with more sophisticated high net worth people. And I realized it was a little bit of a nearsighted goal. In reality, the high net worth people out there, what they want is equity growth. They want to grow their net worth. And they're going to do that more with more value add deals, developments than cash flow ish type of investments. But I recognize it because I was there at one time myself, right? Like I wanted cash flow today. I want to put food on the table. There's all these city sayings, cash flow is king. Depends on where you are in terms of the wealth building journey, right? If you're newer, yeah, cash flow helps you get off of the bench and into these types of investment with more confidence. And if you want that, there's like our tax PAL fund where you invest in ATM machines and you get a pretty nice pref paid monthly on that. But you're not going to get that huge equity net worth growth off of that. It's one or the other. But I'm all for baby steps here, right? It took me a long time starting investing in 2009 and then getting more into this world in 2015. It took me a long time. So I don't discredit anybody if you still want cash flow, but just know that you need to, grow into the world of more equity growth and net worth growth. And at least you're aware. What I'm trying to do is bring the awareness to this and expedite timeframes because it took me like more than a decade to get this concept. And think about it, right? Like most of you guys have jobs or have more than enough investments to put food on the table. What do you need cash flow for? And I'm saying like, if you have a job, cash flow should not be the goal. But anywho, if it helps you get off of the bench and more into alternative investments, especially if you're under $3 million net worth, then yeah, do the tax PAL fund. That's what that's for. It's primarily for the tax benefits. So it's primarily for you investors doing the real estate professional status, you getting a whole bunch of passive activity losses from the tax PAL fund to drive your income down to pretty much nothing if you want. There's more videos on that at thewealthelevator.com/tax. If you're applying this infinite banking double dip plan And instead of going into value add deals and development deals for this kind of green portion of the time frame here, and you use the investment vehicles of the tax file fund, you prime the pump and that more instant gratification cash flow sooner. And if that gives you the confidence to go into more value add deals as you lean into this world in year 4, 5, 6, and beyond, then so be it. You did it a lot faster than I did. Anyway, we'll end with that. Hopefully that kind of helps connect some of these strategies that, again, I'm the messenger boy in a way. These are a lot of the best practices or things that have come up from our inner circle community and people who've gone through this journey prior to 2018, and just trying to make it a little bit better for the next guy. But yeah, thanks for joining, folks. We'll see you guys on the next month, the third Saturday of the month. We'll upload this video in the syndication e-course for you to review and replay later. And yeah, hopefully you guys are seeing how these strategies all go hand in hand. But all right, guys, we'll talk to you later. See you next month. Bye.